This episode, I'm sure it's going to be hard to hide your just gleaming smile talking about one of your favorite topics.
We'll have to. The Christian perspective is some repenting, So we'll
idolization.
That's right. We'll figure it out.
We're going to talk about one of your favorite topics, Jason.
Oh, love it.
We're going to talk about stocks. Last week we talked about Bitcoin and a digital currency. I think it prompted listeners to ask about, hey, what about the stock market? That's a kind of an investing.
Yeah, I'm certainly more in my wheelhouse with stocks than I am with Bitcoin.
Yeah.
Joe, what's your level of comfort with the stock market and the topic?
I feel pretty good.
Okay. And
that's just because I don't know much about it, so therefore I just wanted the basics so I can be a good steward. So I wanted the easy button. So I feel like I know some basics.
Yeah, cool. All right. Well, play dumb for us a little bit. What is a stock?
A stock is technically a ownership stake in a publicly traded company.
Beautiful.
Nice.
You can have stock in a private company, but generally when we say, and that typically comes out in like employee stock programs and stuff like that. But generally speaking, it is publicly traded. It's a corporation. And so if there are 100 shares of Apple stock and you own one, then you own 1% of Apple. And that as an owner, you are entitled to 1% of the profits that they distribute and stuff like that.
Wouldn't that be nice?
1% of Apple would go a long way.
Okay.
For sure.
So that's what a stock is. What is the stock market?
So typically when people say stock market, they are referring to like the S&P 500 or the Dow Jones. And those are baskets of individual stocks. So the S&P 500 is kind of the easiest to wrap your head around. It is the 500 largest U.S. companies. Publicly traded companies. Mm-hmm. There are some other caveats. They have to have been profitable for a certain amount of time and stuff like that. But generally, if it is a publicly traded company and it's big in terms of market capitalization, we can talk about that later.
Yeah.
But big, then it's in the S&P 500. Okay. So it's companies you recognize. Apple is always number one or number two. NVIDIA's one or two up there. Google, which is Alphabet, Nike, ExxonMobil. If you've heard of it and they're a big company, they're in the S&P 500.
And the list would be constantly refreshing and updating, right?
Constantly is the wrong word.
Oh, okay.
It is dynamic. It is reassessed basically so there's some human intervention and like a board that determines. So if most recently it changed because Capital One and Discover merged, and they were both in the S&P 500.
Right.
So then there were only 499, and there was this spot. So the board was like, okay, we have to add another, and so they looked at the next eligible one. Yeah. But there's some forgiveness. Like if a stock is number 500 and it starts to do poorly, it won't immediately be removed. It will kind of be like put on notice, and if it doesn't recover, then eventually they'll say like, okay, we'll reassess and bump someone else in and bump you out.
So there's good staying power for these companies to just kind of stay put. I mean, if they made it to the top 500,
yes. There's it's not like updating every hour.
Yeah.
And there's huge benefit to being in the S&P 500 because lots of people buy the entire S&P 500. Mm-hmm. So when a company moves in onto that list, their stock individually rockets immediately because there's now much more demand for it because everyone who's buying the S&P 500 is getting a little bit of share in it, but that pool is just so big.
Yeah. We are a news organization, and you could tell that they talk about the stock markets a lot in the news, and I feel like good news, bad news influences the stock market going up and down. Yeah. So what's happening there?
So stock market famously famously unstable. Never the same. You can just open it up and watch the price of the S&P 500 move moment by moment while the market is open. Mm-hmm. So if you think of it as each individual company, the stock price represents what investors are willing to pay for ownership in that company. Mm-hmm. So at its most fundamental, and this is generally how private companies are valued, is saying like, okay, if we'll take Apple, if Apple is saying, hey, we're going to pay $1 per share every quarter, then if you own one share, you will get a dividend of $4 in a year, assuming you believe that they're able to do that. So the share is worth whatever you would be willing to pay to have this kind of recurring stream of money coming in. And that's the premise of it, is if you're trying to say what is all the money that owning this company will bring to me, and what is that worth to me today?
Right.
But then there's this constant speculation weighing of judgment of like, oh, Apple is saying they're going to sell more iPhones, so it's worth more because they're going to make more money. Or, China is, now hostile towards Apple. That market's probably going to do poorly, and that's going to reflect on how much money Apple can make. So all that's happening on an individual level. Mm-hmm. And so individual stocks move primarily based on individual news. They report earnings. They say it's going to be a good year, a bad year, whatever happens, news. The founder is leaving. So all of that changes investors' judgment of what this company will be worth in the future. And then there's kind of macroeconomic news that impacts all the companies. So right now there's the war with Iran, and it's saying that's making oil much more expensive, and that's impacting everything. So the fear is, hey, if everything costs more, then consumers will buy less and companies will make less money.
Right.
But then that's being offset with like, oh, but now it's saying the war's almost over, and then no, the war's almost over. And so it's this constant projecting out of what the company will be worth in the future. Mm-hmm. And some of that is company specific. Some of it is the macro economy moving all the companies up and down.
Yeah, I love that. And the basic explanation was super helpful. Am I correct in saying that not all companies give out a dividend?
Totally, yeah. Lots of companies are unprofitable. They don't have money to distribute. And then also the way that dividends work in practice is it's very hard, I'll say politically, to lower or change your dividend. So often what companies will do, and it's a tax inefficient way to return money to the shareholder, because a corporation makes $100, they have to pay taxes on that, and then they give money to you, the owner, and you have to pay taxes on it. And so it's been taxed twice. Whereas the more popular thing to do now is share buybacks. So you have $100 and you just buy back your own stock. So there was 100 shares and you owned one. Well, then Apple bought one of the shares, and when Apple buys it, it disappears. So now there's only 99 shares.
Right.
So you have instead of 1%, you have slightly over 1%. And money wasn't lost inefficiently to the government through that.
Going back to the macro and how the market reacts to wars and oil volatility, is the stock market performance reflective of our economy? Is it right to say, is the stock market the same thing as the economy?
It is not the same thing, but they rhyme. They're very interrelated. The economy is. It's probably easiest to think of the economy as today, now, what is happening, how many people are employed, what is production, what is consumer spending happening. And again, the stock market is this sentiment of what the future will be. So if economic news comes out and it's wow, there are way more people unemployed than expected, then that is going to say, oh, wow, there are fewer people employed. That means there's fewer people with money, fewer fewer consumers, or the consumers are spending less. So the future revenue or the future profit of these companies is now gone down. And so I'm willing to pay less for the companies.
Right.
So it's related, but the economy can be bad with the stock market, reflecting optimism, or vice versa.
Gotcha. So the stock market performance is kind of reflecting the overall sentiment of the people on future projections.
At its best, it's also remarkably fickle. And one of the great investing lines, John Maynard Keynes, the market can stay irrational longer than you can stay liquid. So this is saying being liquid is you have money to be able to invest in it. So you can correctly say this stock, this company should be worth more, and you can be right. And the market can just price it irrationally for longer than you're able to keep the money in there, So there's some it feels like it should be rooted more in some objective truth of sales are this, profit is this, growth is this is what the company's worth. And that is true for a lot of companies and more established companies, but you get companies like Tesla where there's a lot of faith in Elon Musk being able to do the impossible, and he's done that before. And there's a large investor pool that is willing to put their money where their mouth is and say, no, I really want Tesla stock, and I don't care if it's overpriced because it's going to be worth $20 trillion, and I'm in.
Yeah.
Hey, it's Emily from The Pour Over. Not all habits are created equal. Scrolling social media first thing in the morning, bad habit. Checking Upside before I get gas or pizza, life-changing habit. Honestly, opening my Upside app is autopilot. Every pizza night, my hand moves to my phone before I can even think about it. My subconscious is trained. Cashback is waiting for me in the Upside app. The process is so simple. I don't even have to think about it. Just open the free app, find an offer, claim it, make the purchase, and celebrate. I've earned cash back. Upside has given back $1 billion to its users. To find out how much you could earn, download the free Upside app and use promo code TPO to get an extra 25 cents back for every gallon on your first tank of gas. That's an extra 25 cents back for every gallon on your first tank of gas using promo code TPO.
With that quote, the market behaving irrationally, can the market be manipulated or rigged in any way?
Man, so fun. You have the Securities and Exchange Commission, SEC, which was created to stop the market from being manipulated or rigged. But there's certainly lots of illegal activity that can and has and is, attempted to be stopped. So let's go through some of the things. These are things that are illegal and you should not do. We'll just be upfront with that. Insider trading. So Martha Stewart is our famous insider trader. She owned stock in a biotech company called ImClone. I think that's what it's called. And in 2001, the CEO learned from the FDA that ImClone's cancer drug was not going to be approved, and the stock will tank. And so he tells his broker and his family, hey guys, I'm about to announce, but get out before I announce because this isn't going to be good.
Yeah.
And his stockbroker was also Martha Stewart's stockbroker or something like that, and tipped her off. And so she sold 4,000 shares the day before the FDA announcement and avoided $45,000 in losses. Ooh. And so when you're a public company, there are all these financial disclosures and regulations around how it's saying anyone can invest. And because anyone can invest, we need to do everything possible to make sure everyone is working from the same information.
Right.
And so announcements need to be made at the same time. If you have insider information, you're not allowed to act on it. That CEO, CEOs of publicly traded companies or people with inside information, they have to declare, way in advance. There are certain windows where it's okay, if you're an insider, you're allowed to declare what you're going to trade in 90 days. And so it's not based on, you're allowed to sell, but it's not based on your insight. You know? And she was, now, and this is just a theme in all white collar crimes, she actually did not go to prison for insider trading, but obstructing justice and lying to investigators. Just another note, if you do something illegal, just own up to it. It's so much, they get Al Capone on tax evasion or whatever. So,
that technically was what they hit Martha Stewart with.
She spent 5 months in prison for obstructing justice. So that's one. Insider trading is certainly a way to manipulate or, rig things. Pump and dump schemes. So this is what Jordan Belfort did, the Wolf of Wall Street.
Yeah.
So he found like penny stocks that no one knows anything about and would buy some and then go around and hype it up to people and tell people like, oh, you need to buy this, like they're about to blow up and whatever. And then all these other people jump in, driving up the stock price, and then you get out before everyone realizes it's actually worth pennies, like it should be a penny stock. So that's not allowed. Cornering the market, so that's buying all the supply of something so you can control the price. One of the famous examples of this, the Hunt brothers did this with silver in 1980. They just bought all the silver and drove up the price from $6 to $50. So they're single-handedly manipulating the price of silver, and then they went bankrupt and the price of silver crashed. And so the SEC's goal is to say there are certainly ways to manipulate the market and rig the market, and they're trying to smooth that out and say, no, we're protecting against it.
Yeah.
And then in this category, so meme stocks, we talked about
cryptocurrency last week.
Talked about crypto last week, and we were just talking about the market behaving irrationally. So meme stocks, the famous example is GameStop. It was objectively everyone agreed, this company is not worth, I forget the numbers of what it was worth. Let's say these are totally wrong.
Yeah.
But let's say it was trading and it was worth $1 billion. And all these retail investors, so that's you and me, not banks, not hedge funds, just everyday people with their Robinhood apps, looked and saw that the big banks, that the hedge funds had been betting against GameStop. So they were betting on GameStop to go down. They held short positions on GameStop. And so they just kind of, it smelled like a pump and dump scheme, but it wasn't really, because they were just trying to stick it to the man. They all bought this stock and just drove up the price basically purely to hurt the man, the hedge funds. And so there was a lot of investigations of is that allowed? It's the point of the SEC is to say, hey, no, don't let the market figure out what the price is and don't manipulate it. And this is clearly some manipulation, but it was just kind of a new category of manipulation. And I don't remember how that ended. I don't think there was
any repercussions.
Yeah, I mean,
to it.
If you bought it really high, the stock dropped and you lost money.
Yeah.
And that's what the SEC is trying to protect against.
Right.
Is people who aren't in the know buying it and then losing money. But yeah, I don't know if anyone went to jail for that.
Yeah. Okay, I'm gonna get into a more moral question. Growing up, my mom would tell me stocks are gambling. And that was just kind of this idea that I grew up with when I was really young. So I'm wondering, my mom might not be the only one who has ever stated that. And just like you're talking about, markets behave irrationally and all these things can happen. Is it gambling? What are your thoughts on that?
It certainly can be. I would say if you are day trading, meaning you're buying and selling the same stock within hours of each other, just trying to you're not betting on a company's future profitability. You're saying, I'm going to put money in because I think there will be a temporary spike and then sell and I can get rich quick. Or there are lots of options and derivative things where, so for example, you, instead of buying the stock, you buy an option to buy the stock at a certain price and at a certain time. So effectively, the difference is it magnifies the risk because it will, if you say, hey, I want to buy Apple stock at $2 tomorrow, well, if Apple stock goes up to $10, then you want to exercise that option because you buy it at $2 and it's immediately worth 10.
Right.
But if Apple stock's worth $1, then this option to buy is worth 0. So it magnifies it because instead of owning Apple stock, which is realistically not going to be worth $0 tomorrow, your option to buy Apple stock at a specific price could be worth 0 tomorrow. So there are all sorts of ways to turn this into gambling. But I would say kind of firmly that if you're buying the S&P 500, if you're buying a basket of stocks or multiple stocks or reliable companies with a long track record, it's not gambling. It's if you're going to sell tomorrow, hey, you might lose money. But if you buy the S&P 500 because you are trying to retire in 30 years, there is strong evidence that it will be worth more money and that is good stewardship of that money, and you're not gambling with it.
All right, Jason, earlier in this conversation, you mentioned this bigger word, market cap, and you're like, hey, maybe we can talk about that later. So I assume that there are very specific words and terminology as it relates to stocks and the market. So sounds like you have a pre-thought through list of terms and definitions that we can go through.
Yeah. You want to just run down the list and I'll give a quick definition?
Yes. Public versus private.
Main difference is who can own the company. So a public company, and the first time you go from private to public is called an IPO, an initial public offering. There's lots of disclosures that need to take place. And it's like, hey, now anyone can buy and own part of this company. So Apple, Microsoft, those are publicly traded companies. Private companies, you have to know someone to own it. So it's like the founder owns some. Maybe you're an employee or you're an investor and you have a personal relationship. So like Chick-fil-A, if you love Chick-fil-A and want to own Chick-fil-A, you can't just buy Chick-fil-A stock. The pour-over, if you love the pour-over and want to own part of the pour-over, like you can't. No, there's not a marketplace for anyone to just buy stock in Chick-fil-A or the pour-over.
Gotcha. Okay, market capitalization.
So for publicly traded companies, this is like the total value of the company. So if there's 100 shares outstanding and they're each worth $2, then the market cap is $200.
Going back to private then, which is not publicly traded, so you don't have like a public price out there. The market cap, is that kind of like this fluid thing that you just have to best hypothesize what your total value is of that company? Yeah.
So with public, I would say it's much more fluid with a public company because it's changing every moment and you have a set price at any given moment. With a private company, you'll typically do like funding rounds and that's when the company is valued. So you'll say, hey, there are more investors coming in. We have to take a beat and figure out what it's worth. Okay, it's worth $100. Everyone is buying in at this valuation. And then you can reference that valuation in the future, but it's not continually updating. It takes effort because there's not this whole marketplace for determining its value.
Right. Index funds versus mutual funds.
Yes. So they're very similar in one sense. They are both baskets of stocks. Index funds are passively managed. So the S&P 500 is an index fund. And in the sense that it's saying when you buy this, you're getting the 500 largest companies. There's some thought that goes into determining what those are, but generally you get this and it is what it is. Whereas a mutual fund is managed by a human. So you could have a mutual fund and then I give you money to invest. And what I'm betting on is Joe is good at picking stocks. He's good at identifying companies. And historically, famously, mutual funds underperform index funds. And part of it is they have much higher fees. With an index fund, there's a very low fee. There's no one to pay. Whereas with the mutual fund, I need to pay Joe because he's working every day to buy and sell things and make money.
Yeah. Bonds.
So stocks are what is called equity ownership in a company. Bonds are the other half. If a company wants to raise money, like they need more cash, they can either sell equity or they can go borrow money and get debt. So publicly traded debt is what a bond is. Let's say Joe Corporation is saying, I want $100. Then the market would give $100 and Joe would make coupon payments, their interest payments, typically every 6 months. And so if you buy a bond from an Apple bond, Apple is going to pay you interest every 6 months. And then at the end, you'll get the principal amount back. So it's steady payments, and you will for sure get the payments as long as the company doesn't go bankrupt. So companies that you don't think are going to go bankrupt they're very low risk. You're going to get a low interest rate, like 4% or something. Whereas a company where it's like, hey, there's some risk that they won't, they're saying they're going to pay me this every 6 months for the next 5 years. I'm not sure they're going to be around in 5 years, that they might have to pay 10% in coupon payments to make up for that risk of them going bankrupt.
Right. All right, my two favorite Chicago teams, Bears and Bulls. Tell me about that.
Yeah. So Bears swipe down. And so when the market is going down, you're in a bear market. And specifically a bear market is if it's down 20% from its most recent high. So talking about generally the S&P 500 is we're in a bear market if it's doing significantly bad over some period of time. And a bull market is the opposite. It's not necessarily 20%. It's just like a sustained upward because bulls, thrust upward with their horns. I don't know. It's been around for a long time.
Short versus long.
Yeah, so we briefly talked about shorting. So if you're long a stock, that means you are betting on it to go up. And if you're short a stock, it means you're betting or predicting that it will go down. Now, the mechanism for shorting a stock is kind of fascinating. So if I think a stock is going to go down, I don't want to buy the stock because I think it's going to go down. So what I do instead is let's say you own the stock. Mm-hmm. I borrow the stock from you and sell it. And then and I have to pay you a little fee to do this. So, and then the hope is that when you want it back, or by the time I have to return it to you, it's gone down in value.
Right.
So if the stock was $100 when you gave it to me, I then sell it.
You have $100 now.
I now have $100.
Yep.
The stock goes down to $80. Well, I don't owe you $100. I owe you the stock. So I then go buy the stock for $80 and give it back to you, and I have $20.
Oh.
So that's how you short a stock.
Got it. Stock split.
So a stock split does not change the market capitalization of a company. It's saying if there are 100 shares and they're each worth $1, now there's 200 shares and they're each worth 50 cents. So the reason companies do this is if they have been going up in value for a very long time, buying a single share of the stock may feel inaccessible to some retail investors or more often employees. Like you want to be able to reward companies in stock. And if it's like, well, man, each share is worth $10,000 and
no way.
I'm not trying to give Joe 10,000. I'm trying to give him 100. You can split the stock to do that.
Gotcha.
Berkshire Hathaway, Warren Buffett's baby, famously has never split their Class A stock. You want to? Any guess?
How high is it?
How high is it?
Is it
higher? I don't know what you're going to guess,
but it's higher. So last week, the current price of Bitcoin was, my guess was 80,000. I was close. I'm going to guess 80,000 for Berkshire Hathaway.
700,000. If you want to buy one share. And rumor is that Warren Buffett personally follows the trades of these and knows who owns them. And part of the reason he hasn't split the stock, and they have a Class B stock, which is much more affordable, but hasn't split the Class A stock because he wants to have it be this like you stick with it for a long time. You're not trading it. This is not a thing. This is something you will down. Like you have a Berkshire Hathaway A-class stock. You don't have the retail investors trading it. You have long-term, faithful, committed investors who believe in the future of Berkshire.
Is that the highest price of a stock?
Yes, so that's the highest stock price. But again, what really matters is the market cap, the overall value of the company. So the most valuable company right now is NVIDIA. It's like 4.7 trillion, give or take, and Berkshire's nowhere near that high. But a single stock of NVIDIA, I don't know what it is, but it's probably $800 or $500
because there's so many shares.
There's so many more shares.
Yes, makes sense.
And so I talked about the S&P 500. There are two other when you talk about like the market. The S&P 500 is probably the primary one now. There's also the NASDAQ. It's like 3,000 companies, so much more, and it's focused on tech companies. So the NASDAQ is both a stock exchange, which is where companies like go public and list. And then there's an index of like all the companies that are listed on the NASDAQ. And so it's like 3,000, a little over 3,000 companies, and it tends to lean towards tech companies. And then there's the Dow Jones. And the Dow Jones is by far the oldest. It was like 1800s, 1890s or something when it started. And it is 30 companies. Ooh. And the reason I bring it up, the difference is, so when you buy the S&P 500, it is weighted by market cap. So if you were to spend $500 buying the S&P 500, you don't get $1 of each 500. You would get much more NVIDIA because NVIDIA is a more valuable company than you would of the 500, number 500. The Dow Jones is a price-weighted index. So there's only 30 companies, and it is based on the stock price. So a stock split, if one of the 30 companies splits their stock, the Dow Jones will drop significantly, even though no value has been lost. It's a holdover from like you had to do everything manually in 1896, and it was easiest to just look at the share price and add all the share. Hey, there are 30 companies. I added these three prices together. Right. We do it, and we do that a couple times a day, and that's what the market is doing. It's the oldest. It's also just the worst. It's the least effective. There's only 30 companies, and it's price weighted, which doesn't really make sense. But it's still mentioned because it's been around for a long time.
Yeah, that insight into it is very helpful. I did not know that. Should we move on to fun facts?
I don't know how fun these are, but there may be more context.
Okay.
So the S&P 500, we've been talking about that. To give some context, a average year, the S&P 500 will go up like 10%. It almost never goes up exactly 10%, but when you average the years together, Warren Buffett, over his career, he averaged 19%.
Dang.
Okay.
Where's Warren Buffett's mutual fund? I want to
that's Berkshire.
Him. Yeah.
Honestly, like that's what Berkshire Hathaway is. It's a big company where it's companies that Warren Buffett has bought. And so if you want his philosophy, you buy Berkshire Hathaway.
Do you have $700,000 that I could borrow?
No, but you could buy the B class stock. It's the same stuff. But I bring that up briefly to say, and in recent years, that his 19% is also weighted more towards his early years where he had larger returns. And it gets harder to have larger returns the bigger the number is. So it's in recent years, it's been closer to 13%. So if anyone is claiming that, hey, I can really outperform the market and I'm going to get you 25, 30%, or I've gotten 50 or 100% returns the last few years, it will not continue. Because if it did, or if they had actually done that for any sustained period of time, they would be famous. They would be Warren Buffett. Like Warren Buffett did this consistently, and I didn't have to explain who Warren Buffett was to you. Everyone who's listening to it has heard his name. So do not be duped by the TikToker who's claiming to have had years of great returns and give him money, because if you were really that great, you'd know who he was.
Yes. Yeah. Okay. Let's close with some Christian perspectives.
The one that just jumped off the page for me here was eternity and keeping an eternal perspective, because nothing drags my eyes down to earth more easily than money. And it feels like I can justify it as stewardship, and there's legitimate calls on us to steward money well and provide for our families and do all that. But it's just such a tangible way to measure success and stability and comfort. And those are things that belong to God, and that I should not be looking to money for or anything on this earth for. And so it's one of the reasons that Jesus talked about money so much, is because it so easily competes for our affection. I am in no way unique in being interested in the stock market or drawn towards money. And so I need constant reminding to focus on eternity, building eternal wealth, and finding my security and hope in Christ and in eternity, and not in a bank account.
Amen. What a great way to end it. Thanks, Jason.
Yeah, hey, this was fun, right?
Yes, it was.
Fun for me.
Yeah, it was fun for me too. Yeah, just your energy around this is infectious and palpable. So, all right. Well, thanks everyone for joining us on another episode of TPO Explains. As a reminder, you can watch this episode on YouTube and Spotify. Make sure to like, comment, and subscribe. We'd love to hear your thoughts and feedback. Thanks for tuning in. Until next time.
Bye.
Hey, it's Emily from The Pour Over. Summer heat is right around the corner, but honestly, I'm not worried. I have a secret weapon, Sparkling Element. Whether I'm outside with the kids or working in the office, Sparkling Lemonade Salt is the refreshing, crispy pick-me-up I need. One can serves up a science-backed ratio of electrolytes for max hydration and sugar-free flavor. It's the refreshment of soda, but good for you. TPO listeners get a free 8-pack of Element's most popular drink mix flavors with any purchase. Just use the Element link in the show notes. There's really no reason not to try it.